a seaside resort in Scotland, a handshake worth $1.4 trillion. America didn't just cut a trade deal, it weaponized one. Europe paid in cash, leverage, and influence. This wasn't compromise, one analyst said, it was an economic strike. Welcome to the age of weaponized trade. For months, whispers of a US-EU trade war had grown louder. In Washington, a 30% tariff threat wasn't just policy, it was a warning shot. The European Commission knew the stakes. Auto giants, chemical exporters, and luxury brands could lose billions overnight. Markets in Frankfurt and Paris watched headlines with the same tension as generals tracking troop movements. And then, instead of a war, came a deal. But this wasn't generosity. It was leverage, wrapped in contracts, energy for security, market access for investment pledges, tariff exemptions traded for long-term capital inflows. The fine print locked in U.S. energy sales, industrial reshoring, and technological edge, while Europe bought stability. This wasn't just a deal, a Brussels insider warned, it was a doctrine. The setting, Turnberry, Scotland, July 27th to 28th. At the table, Donald Trump and Ursula von der Leyen, flanked by trade and security advisors. The numbers tell the story: $750 billion in European purchases of U.S. energy, oil, LNG, and renewables over 3 years. $600 billion in EU investments into U.S. infrastructure, defense, and advanced manufacturing. A 15% tariff ceiling on most EU goods, half the original threat, but still triple pre-Trump norms. Exemptions, aircraft, semiconductors, critical chemicals, and select agriculture. Pressure points remain: steel and aluminum at 50%, pharmaceuticals under negotiation. To the public, a balanced compromise. But behind closed doors, one negotiator admitted, it felt less like a treaty and more like an arms deal. Only this time, the arms were contracts, not missiles. By mid-2025, Europe's supply chains were strained, energy costs volatile, inflation eating into wages. The 50% steel and aluminum tariffs already hurt manufacturers. EU leaders faced a choice: gamble on a tariff war that could cost $400 billion annually, or pay for stability. They paid. But this wasn't just about economics. NATO commitments were woven in, turning trade into alliance management. Trade was the hook. Security was the glue. As one Atlantic Council analyst put it, this was not a trade negotiation. It was an alliance negotiation disguised as commerce. This deal unveiled a template. Commercial diplomacy, threaten tariffs to create urgency, offer market access in exchange for massive investment pledges, embed strategic commitments into the package. The result? The initiator locks in years of capital inflows, while the partner buys predictability. Japan followed quickly, 15% tariffs capped in exchange for $550 billion in US-bound investment. Now, South Korea, Brazil, and others are lining up, each trying to bring the richest package to the table. Trade has shifted from mutual benefit to a battlefield where market access is the prize and investment the ammunition. American energy dominance. Europe's $750 billion pledge bankrolls U.S. energy. LNG terminals run at capacity, guaranteeing American independence and leverage abroad. Supply chain realignment. Access to U.S. markets is now conditional. Preferred partners get priority in chips, defense, and resources. Others risk exclusion. Markets and critics. Markets rallied. The S&P 500 jumped 3% in a week. ASML and Infineon surged on capped chip tariffs. But critics called it economic surrender. One French economist argued, Europe didn't negotiate a deal. It signed a dependency contract. Analysts draw parallels to the Marshall Plan, but in reverse. In 1948, America pumped money into Europe to rebuild allies. In 2025, Europe pumps money into America to secure stability and avoid collapse. As one professor put it, it's the Marshall Plan in reverse. Only this time, the fine print favors Washington. Winners, United States. Energy exporters, Exxon, Cheniere, Chevron. Locked-in multi-year European contracts. Defense manufacturers, Lockheed, Raytheon, Northrop, boosted by $600 billion in EU-linked investment. Tech and chips, semiconductor fabs and suppliers, supported by tariff exemptions. Selective winners, Europe, aerospace, Airbus supply chains protected. Chipmakers, ASML, Infineon kept U.S. access. Critical chemicals spared from 30% tariffs. Losers, steel and aluminum sectors in Europe hit with 50% tariffs. Pharma exporters left in limbo. European consumers paying higher prices as tariffs pass through supply chains. EU autonomy advocates warning Brussels traded sovereignty for short-term calm. Scenario 1. A full trade war. Automobiles, luxury goods, agriculture, losses topping $400 billion per year. Scenario 2. Pivot to China, politically toxic with NATO expansion looming. Scenario 3. Delay. Markets hate uncertainty. A Eurozone slump could follow. By those measures, paying the price wasn't surrender. It was survival. The precedent is set. Japan already signed. South Korea may pledge $400 billion in defense and tech co-investment. Brazil and Mexico face pressure, compete for access or risk supply chain exclusion. China reads this as containment by commerce. Without equal leverage, Beijing risks losing influence in Europe and beyond. One strategist summed it up bluntly. The map of global trade is being redrawn, not in treaties, but in checks. In one weekend, America proved trade is no longer just economics. It is a weapon, a shield, and a bargaining chip. $1.4 trillion changed hands. Industries realigned. Security commitments were inked in invisible clauses beneath tariff schedules. Europe chose stability over autonomy. America chose dominance over compromise. And now the world asks, will Asia pay to join the club? Will emerging markets be frozen out? Will Europe regret the price it paid for peace? Because in the age of weaponized trade, every deal has a cost. And the question isn't if others will pay, it's how much they'll lose when their turn comes.